What's up, guys? It is April 1st, 2022. We're going to go over last month's real estate market here in Jacksonville, Florida, and cover what we're looking for next month. So stick around. I'm Jamie Tajera, co-owner of Edge Group Real Estate here in Jacksonville, Florida. This is Carrie Hustis, co-owner and team lead. While Carrie runs all things sales, my day-to-day with investments and developments keeps me in two places: in the field, checking out potential opportunities, and on the computer, researching hyperlocal data. So if you're looking for insight on Jacksonville real estate, you've come to the right place. Thanks for checking out our channel, and if you like it, please be sure to subscribe. Okay, so first things first, as far as like team news, you guys might notice that I'm wearing EGRE, Edge Group Real Estate shirt, but we are actually rebranding our team to Property Bear, which you can see on the screen right there. And basically the reason we're doing that is because we want to be able to, there's two big reasons, real simple. One, EGRE, although it's Edge Group Real Estate, doesn't spell edge. We want our brand to be simple to where a third grader can understand it. Outside of that, from a retail standpoint, nothing else really changes. And then the other part is that our real estate group and team is involved with more than retail, right? More than, on these reports and everything we're talking about, I would say 50% of it is around, what it means to you as a traditional buyer or seller of real estate. But we're also working with land acquisitions, multifamily, like apartment buildings, buying houses, fixing them up, reselling them, stuff like that. So we wanted one brand that can kind of, tackle all of it. Property Bear land development, Property Bear, multifamily apartments, and of course, Property Bear agents with Keller Williams. So, that's why we're doing that. So jumping into our upcoming projects, if you visit our website, there's like the little secret link, but it's edgekw.com/listings. You'll see all of our upcoming inventory. We've closed on it. We own it. We're, in the process of renovating it. And you guys have access to it basically. We've got one in Murray Hill, 3-bed, 1-bath. We're having to redo everything on that house: roof, AC, plumbing, electrical. It's basically going to be a brand new house in Murray Hill. And then we've got one on the west side. We're turning it into a 4-bedroom, 2-bathroom. It's a brick house. It's awesome. It's on a corner lot. It's not going to last very long. We just picked up another one over by NAS Jacks. That's a 3-bed, 2-bath with a carport. Awesome little concrete block house. We're actually going to look at it today. I don't know what the inside looks like, but that's what we are going to find out. From an economic news, so one of the things that you might have heard if you're listening to, Bloomberg or Wall Street Journal or anything, is them talking about the inverted yield curve, which is always basically a ticker or an alarm that goes off and says, hey, we're heading into recession. And so I've got Tom Cruise with his inversion thing from Top Gun. The big thing with that is, yes, it usually fires off a signal and says, hey, this is about to happen. But the other thing is, as it relates to real estate, the reason we're not worried is because there's so many different factors that are involved here. Right now, the crash that we are experiencing is twofold. One, we don't have enough inventory, right? So it's not like this is an over demand, an oversupply of loans like what we saw in 2008 or anything like that. Like, we don't have enough houses for the amount of buyers that are out there. The other thing is that here's a chart from Bankrate that shows, the gray lines are past recessions and what happens to housing prices. The only time that housing prices fell during a recession was, from that 2008, the aftermath of that, basically, right? And it doesn't happen in any of the other ones from a historical standpoint. So I'm not saying it can't happen. Just from what we're saying, I don't see how it can happen. The crash, if you will, that we're experiencing is an oversupply of real estate agents, right? Which puts the consumer in a really bad spot, to be honest. It's just rough. And then we have an undersupply of homes for sale. That's the pinch point. That's the crash that we are dealing with from a real estate standpoint. From a home pricing standpoint, my biggest reason for not being concerned from a pricing standpoint, even though one of the things we're going to go into is mortgage rates, is because there's still so much cash sitting on the sidelines waiting for prices to come down. And I'm not even talking about the sophisticated hedge funds that, are like waiting to pounce and have billions of dollars on the sideline. I'm talking about your neighbor. I'm talking about people that are sitting on the sidelines that, we talk to on a daily basis, and we're like, hey, what are you thinking about, buying or whatever? And they're saying, well, I'm going to wait for the market to come down 10%. And we're like, okay. And we don't see it happening like that. But a lot of people are saying that, and they've got some cash, whether it's from, last year's stock market, rally or whatever. They've got some cash, and these aren't like sophisticated like investment groups that are waiting. So if prices were to dip, we start the whole supply demand cycle all over again. Lack of supply, et cetera, et cetera, et cetera. And home builders are doing everything they can to catch up. But the biggest thing they're running into is labor shortages. So it's like, okay, we're ready to catch up. We'll commit to building more houses. Oh, wait, we don't have enough people to build them. So that's one of the things. In the conversation, I had two big conversations last month. One was with the head of one of the bigger mortgage brokerage agencies here in Jacksonville, and I'm pretty sure they're nationwide, regional. They're huge. And then the other was with one of the biggest roofing companies in Jacksonville. And they're also regional, Northeast Florida. But the labor is an issue. And labor all the way up to, I would almost say like middle range income zone. So like salespeople to sell certain items, like it's really hard to go find those people. And sales is a grind, right? For those of you that are in sales, that you're pounding the pavement, and you're trying to essentially move product while also being a consultant at the same time, especially in real estate. Imagine like roofing or anything else, right? And it's hard to find those jobs or people to fill those roles, especially, with what social media looks like and, the great resignation, or whatever everybody's talking about. And also, let's go down to, even, from a physical labor standpoint, the construction of homes, roofs, stuff like that. I don't see anybody on social media glamorizing that. So it makes it even that much harder to go get into these roles that even in some cases do pay six figures. People just aren't, it's hard to go find that. And maybe it will catch on at some point. And then we'll have a totally different conversation. But until then, it's going to be hard for builders to catch up to that. And then with our mortgage contact, what they're thinking is that the market's going to keep going super strong for 8 to 12 months, and then there's going to be some sort of shift. But the shift is not going to be from like a home pricing standpoint, from a consumer standpoint, from an industry standpoint. Mortgage agencies, insurance agencies, real estate agencies are almost like the service-based businesses of real estate, if you will. And, the thought is that that's going to get compressed, which really makes sense, because if you think about it, you've got around 10 or 11,000 licensed agents right now within just our MLS, and only 2,000 listings. From a consumer standpoint, you don't know the difference. when you're out there looking, or like when you're seeing stuff on social media, you don't know the difference between the people that can actually help you and the ones that just have a big presence, right? And it makes it hard from a consumer standpoint. And we're even seeing that on our end, with the properties that we're selling. There's agents whose customers are, I guess, being advised to drastically overpay for these houses. And when we're measuring some of the, we're looking at who the agents are, and like we know who has the experience. And yes, most homes are going over list price, but in some cases they're going so far over, and we're like, that was pretty bad advice. Even in the way that the offer was structured, it didn't really protect the customer that much. But I mean, what are we going to say? We're not going to say, hey, you're paying too much. We're obviously trying to get as much money for our sellers as possible too. So from a consumer standpoint, that's kind of what to look for from like a national economy standpoint and what's going on with us. For Jacksonville, let's start off with closed sales. So Duval County in March, 1538, St. John's 544, and Clay 357. We're using a different system, so if you're used to seeing something else, this is still pretty similar, right? So I think it's still good to work with. So closed sales are up, right? Past 3 months. That's a good thing. But there's usually a dip in, let's say, like the holidays for homes that are listed. So those prices usually go up because there's less inventory, more competition, right? I want to say it's a little known fact, but honestly, we talk about it all the time, so it shouldn't be a little known fact. But anyway, so, right after the holidays, more people put their houses on the market, so you've got more sales. Here's the thing. Look, 1538, 544, 357, and I'm saying there's like 2,000 listings on the market at any given time right now. That's basically not all of it, but most of the inventory is going out. If you have a listing that is on the market for more than 30 days, honestly, more than 15 days, there's a problem. Like, there's a massive problem. Like, it's either pricing, marketing, condition, something. There's something wrong if you're on there for over 15 days. I mean, the listing agents, the agents on our team, like, they will sign a listing agreement with you for 30 days, because the reality of it is if we can't get your house sold in 30 days in today's market, there's a problem. What we're negotiating for in today's market for sellers is not so much price, it's extras and having to know the difference between when you get, 15 offers, right? You're going to have 3 good ones or 3 high ones, right? How do you know which one is actually the best, not just the highest? And with our experience, we know which agents aren't very strong with their buyers, and their buyer's going to back out and they're going to waste 15 days or 30 days of our sellers' time. Like, we know that stuff, right? Because we're not selling one house a month. We're doing more like 10, 15, 20 a month. So it gives us the experience to be able to help the sellers and say, this is the one you want to take. This one looks like it's more money, but it's probably going to cost you some of that time, and we don't want to lose this one just because this one looks better. Not everything that shimmers is gold. So let's jump to the next one. Sales price. Whoa. Okay. So St. Johns County, your average sales price. Is this showing me the average? I want to make sure it's average. Okay, median. Here we go. Median price. 547. Clay County, you're at 340, and Duval County is at 300,000. Let me look at these filters. Single family, condo, townhouse, and that it does include new construction. I have to include new construction because, for some buyers, that's basically what you're going to get. So here's the only thing that's like hard to like sometimes rationalize, right? Because nationwide we went up, I think it's like 18 or 19% from a value standpoint. It's a little more than 1% a month in increases in value. Jacksonville was way higher than that. But you see, I don't know what this is, 460 to 540, almost a little under 100,000, $90,000 in increase in price. The thing to remember there, and I say this every month right now, is low inventory. It's easier to change, not so much manipulate the numbers, but you have a few more sales at a little bit of a higher price point, they're going to jack the price up, and vice versa. A few more sales at whatever that price range is, regardless of where it's at, it's going to jack that number up or down. Because from what is this, December 21 to February 22, right? Mathematically, I'm telling you, hey, prices in St. Johns County are going down. It must be a crash, right? It's obviously not the case. All right. Inventory. Inventory is crashing. Home inventory is crashing, labor inventory is crashing, and the number of real estate agents is going up. May the odds be ever in your favor. Let's take a look at current mortgage rates. So they have gone up. We like the 30-year. Most people are getting 30 years. January, February, this is just this year, right? You're at a little under 3.5, and now we are almost trying to break 5% at around a 750 credit score. Make sure you have good credit. Every 10, 20, 30 points is going to count. I'm not too worried about this. I'm 35. I just turned 35 in March. And for me, my threshold number for interest rates is about like 5% in my mind, somewhere around 5%. Mentally, I only start to get weird about it at like 6%. I don't know why. I think it's a generational thing. If I said that to my parents, my mom would say we were paying 6-7%, when I was a little kid. So to them, they're like unfazed. This is still super cheap. From an average standpoint, from a national average standpoint, and I think it's over the past 30 years, 40 years, the average mortgage was like 5.25%, I think, somewhere like that. So we're still below historical averages for loans. I could be wrong about that 5.25%, but I saw it on a chart. Either way, for me mentally, I'm still good under 5. Under 6, if I'm getting a good deal, I'm still okay with it. We're still buying rental properties. We're still looking at that. We're looking into other markets because Jacksonville, 2 things happened. One, we got mentioned on 60 Minutes about being unaffordable, rents going up, something like that. And then Zillow talked about Jacksonville being the number 2 market in the country for growth or something. I don't know. So what that did is it created a swarm to Jacksonville. And so the deals that we're seeing are not really deals. They might be deals to someone coming from California or New York, and I'm talking about from a cash flow standpoint, not a living standpoint, because I still think from a living standpoint or from an appreciation standpoint, if that's your game, which is not our game from an investment standpoint, we like cash flow, but if you're playing the appreciation game or the living game, right, you want to live in Jacksonville, Jacksonville's awesome. It's a blank slate, and it's only getting better, but those are the things to check out. So going forward, we do expect interest rates to continue to creep up. I don't know how far they're going to go. The Fed has a habit of pushing whatever lever they're going to push a little too far, one way or the other, and then they always find themselves like chasing the market. So we'll see what happens with that. Even with interest rates going up, I can see appreciation slowing down to a more normal, sustainable rate. I mean, 20% increase in home prices is not sustainable, right? Generally, we're looking at like 5 to 7% year over year of appreciation, which is safe, right? You've got normal inflation at around 3%. That's where you want to be. With home appreciation rates of like 3 to 7, real estate's always been a great hedge. So when you're looking at inflation of, I think it was just ticked at 8%, right? With home appreciation up 20% nationwide, great, but you kind of lost half of it in inflation, right? So just food for thought. We do think that appreciation prices will slow down, but we don't think home prices are going to come down. There's no reason for it. We put up a house and it's still selling extremely fast. So if you have any questions on the retail side, the investment side, about what we're doing, what markets we're looking at, if you're looking to potentially deploy some capital into some of our projects, let us know. And we'll talk to you on May 1st. Thanks for checking it out.